Over the past couple of decades, I've spoken to many successful real estate investors, and you consistently hear about their successes, their failures, and their lessons learned. And one simple rule I always remember is what I call the 10-year law of real estate investing. Welcome to Strategy Saturday. I'm Charles Carillo, and today we're discussing a simple but powerful investment principle that could change how you think about real estate. It's called the 10-year law of real estate investing, and this principle has helped investors build wealth, reduce risk, and create true financial freedom. But what exactly is it, and how can you use it to your advantage? Let's get started. Recently, I spoke to a newer real estate investor, and we discussed their buying a small apartment building. And one question he asked was about how best to lower his risk. And I shared with him my standard 3 points for limiting risk when investing in multifamily: buying a property that cash flows, having long-term fixed-rate debt, and having a reserve fund. Another point that came to mind was one I call the 10-year law of real estate. Now, we learned this informal principle from a seasoned apartment investor many years back. He didn't really have a name for it, but he stated that if you purchase real estate and you hold it for 10 years, the chances you will lose money are very minimal. He was referring to apartment buildings, what the asset class that he invested into, but you can really utilize this principle with all types of properties and possibly other investments like index funds. Now, the investor had been through a few real estate downturns and said that the only time he lost money on a real estate deal was when they were short-term investments. And as you give your investments a runway, there is a higher probability of success. Of course, this is a broad investment principle, and the ones heard from old school investors who kind of back of the napkin investors that made most of their investment decisions using common sense and simple calculations instead of complicated spreadsheets. Still, if you go into investment with a 10-year horizon from the beginning, it simplifies the investment process. There is not so much of an urge to negotiate every penny out of the deal or walk away from deals where the seller refuses to renegotiate every item your inspector found during the inspection on the report. In other words, it is a less stressful buying experience. So there are a few main reasons why I like the 10-year law. Number one is that real estate is a buy and hold business. To truly build wealth in real estate, you need to buy and hold properties. Additionally, the tax system surrounding real estate incentivizes investors who buy and hold property by offering generous depreciation deductions that are not recaptured until the property is sold or past your heirs and avoided altogether. Now, this point is always forgotten during hyper buying sprees in real estate in these hot markets where people are trying to make and double their money in 2-3 years or something like this. And it's something that we have to come back to when markets cool and we're going down or going just sideways. Number two is a 10-year investment horizon allows investors to make it through any market volatility. Now, suppose investors find themselves in a down market in 10 years when they have to refinance. In that case, it will be much easier to refinance a property with a 50% or 60% loan to value versus an investor who had a 3-year term loan and is trying to refinance a property with an 80% or 90% or even higher loan to value. Number three is avoiding transaction costs. Now, when selling a property, transaction costs totaling 8% to 10% are not unheard of when you factor in broker fees, taxes, and closing costs. And this can be minimized if you hold your property for 10 plus years. Number four is the current value of the property and the market don't matter much during the hold period. Now, if your property is cash flowing and you're not planning on refinancing it or selling it, tracking the property's market value does not really matter. It's kind of difficult to do sometimes too, because you have to figure out what cap rates are and you have to keep on checking that and changing it back and forth. But property values only matter when you're buying, selling, and refinancing. Number five is that it is less stressful and less time consuming. It takes a lot of time to research and underwrite dozens of properties to buy one. After you close on that property, your first several months or a year or two are consumed by fixing deferred maintenance. Now, once you complete the renovations, the owner can step back, let the property manager handle all the day-to-day operations. This is where the passive income begins, or semi-passive income begins, and the wealth generation begins. The 10-year law of real estate investing encourages investors to buy properties with a longer time horizon than focusing on riskier, short-term holds and flips where market dynamics can quickly shift and leave investors in a difficult position. If the market slows down, if they have a loan coming due, and they are unable to sell the property at or near their target sale price. So I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then.
If you always want to invest in real estate but didn't have the time, didn't know where to find the deals,
Couldn't get the funding and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.